So rather than clients who drive a lot of the investment banking work and rigor and time schedule, our schedule was dictated by markets. So in California, the stock market opens at 6:30 in the morning. And so we needed to be in our chairs, in our seat, ready to trade and start doing research at 5 a.m. So our office was in Century City, California. And so we were always in the office by about 5 in the morning. We would trade European markets for the first couple of hours. European markets are open before the US markets, given the time change. And so we would, any activity that we needed to buy or sell, trade on the European Stock Exchange or any other kind of related European markets, London Stock Exchange, we would do those for the first few hours, and then
they're before 5 o'clock, right?
That's right. So they opened, opened it probably.
Do you have other people that trade, and you come in and you continue to trade, or
sure,
like tic-tac, or
sure, absolutely. So there's people that trade literally continuously throughout the day at the bank.
If you like this video, please subscribe to my channel, like the video, and share it with your friends. It will really help me grow this channel. 你喜欢这个影片吗？请你订阅我的频道，帮我点赞，也分享给你的朋友。
Yeah, so we had discretion over the pools of capital that we manage. So clients give us capital. We manage that capital on behalf of those clients, those foundations, those endowments. And we would trade the capital that we were given to generate a profit for our clients and earn investment fees or commissions for our own book, right? So we're trading on a for-profit basis. And yes, we would take the Goldman Sachs research, the street research, and try to figure out which companies were attractive to buy. So at Goldman, the trading strategy was pretty simple. Which companies can we buy? Which publicly traded equities could we buy that we thought would appreciate in value? These are companies like Microsoft and Google and Eli Lilly and Pfizer, technology, healthcare, industrials, financials, right? So we would manage portfolios of these stocks for people.
Did you focus on one industry, or
we were generalists, so we focused on everything. We tried to create portfolios for all of our clients, diversified across a number of those different securities. So if a stock was issuing a secondary interest in their company, or if they were spinning off a subsidiary that was also going public, a lot of the things that I traded at Goldman were IPOs and secondaries. So if you're a public or a private company and you wanted to issue public shares, you went to Goldman Sachs to underwrite your initial public offering, IPO. And so Goldman, when they would do that, they would place those shares to groups like mine. And so we would buy and sell and trade those IPOs very, very actively. And that's how we would generate a lot of profits for our clients.
And the funds that Goldman had came from institutions.
Yes. Yeah. That's right.
Okay. Explain to our audience what are these institutions, like when they talk about institutions.
Institutional investors, I would broadly categorize investors in two types: institutional investors and retail investors. Retail are individuals, retirement savings account, high net worth individuals, people that have their own money and they act as and invest as individuals, people. Institutions are organizations that the money is not theirs. So institutions could be companies, it could be asset managers, it could be pension plans, it could be sovereign wealth funds. These are groups of investment bodies that the wealth has been created through certain activities, right? The largest institutional investor, public institution in the United States is CalPERS, right? California Employee Retirement System. The money that they have to manage comes from who? Taxpayers from California, and general activities of taxes, property taxes, payments from public workers, teachers, other government agencies and organizations. That pool of capital then gets invested on behalf of the people that they are serving. So the pension system. So my parents-in-law are teachers, and so they draw a pension from California public, well, in this case, California Teachers Retirement System, another very large institution. So that institution has a lot of money to manage, and they give it to groups like Goldman Sachs or other money managers to manage that money. So the people that say what those investments should be, it's not their money. They didn't earn it. They just represent that institution and they invest on their behalf. And so institutional investors tend to be much, much, much larger, right? California Public Retirement System is a $400+ billion institution versus a high net worth individual or retail investor might have $500,000 to invest or $1 million to invest. So totally different dollars, totally different probably asset allocations, invested for those people. So throughout my career, I've invested for both.